LyondellBasell Industries NV (LYB) is currently trading at $43.09 USD, marking a slight intraday increase of 0.030 or 0.070% as of the close of the most recent trading session on Friday, December 19, 2025. While that flatline movement might suggest a quiet day for the chemical giant, the underlying reality is anything but calm. In fact, if you look at the broader picture, LyondellBasell stock is sitting at a level that has caught the market off guard, especially for those who remember it trading near $80 just a year ago. The expectation among most casual observers is that a legacy industrial player like this, known for its massive scale in plastics and chemicals, should be a stable pillar of a diversified portfolio. But the reality is that the stock has shed nearly 42% of its value in 2025 alone, pushing its dividend yield to a staggering 12.5%, a figure that usually signals a major red flag for a company's financial health or an impending payout cut. This creates a fascinating tension. Is LyondellBasell a falling knife that investors should avoid, or is the market overreacting to cyclical pressures, leaving a massive opportunity for those looking at online investing through platforms like Fidelity or Interactive Brokers? The immediate insight you need to grasp, which many headlines are glossing over, is that this recent price floor around $43 isn't just about weak demand for polyethylene. It is about a fundamental shift in how the company is being valued as it exits its refining business and pivots towards circular solutions. Most investors see a 12% yield and assume the dividend is dead on arrival. However, the company just paid out its $1.37 quarterly dividend on December 8, 2025, and management is vocally defending its investment-grade status. The market is currently betting against that defense, pricing in a worst-case scenario where the commodity cycle stays depressed well into 2027. If you are using an individual brokerage or exploring investing sites to find deep value, this is the exact moment where the narrative of industrial decay meets the hard data of a strategic reset. The recent stock movement has been dictated by a series of sharp downgrades and a heavy Q3 earnings that saw a net loss of $890 million. Now, that number sounds terrifying, but you have to strip away the $1.2 billion in non-cash asset write-downs to see the actual operational performance. When you look at the adjusted EBITDA of $835 million, the business is still generating cash despite the headwinds. Institutional activity has been mixed but telling. We saw firms like Sound Income Strategies and Capital A Wealth Management recently increasing their holdings, while heavyweights like BMO Capital slashed their price targets to $36, citing significant fundamental pressures. This divergence of opinion is what makes LYB a polarizing name right now. On one hand, you have the dividend at all costs crowd, who sees the $5.48 annualized payout as a gift. On the other, you have the analysts looking at the 50-day moving average of $45.17 and the 200-day moving average of $52.36, concluding that the trend is firmly downward. Trading volumes have remained elevated, often hitting 8 million shares a day, suggesting that the weak hands are being shaken out by those who believe in the 2026 recovery. To understand why the price is pinned where it is, we have to look at the macro pressures. The petrochemical industry is currently caught in a vice. In North America, higher natural gas and ethane costs have squeezed the integrated polyethylene margins that LyondellBasell usually relies on for its bread and butter. Meanwhile, in Europe, industrial demand is sluggish, and the company has been forced to run its assets at lower operating rates, around 75% for European operations compared to 85% in the U.S. Gulf Coast. This isn't just a LyondellBasell problem, it's a global chemicals problem. However, because LYB is so concentrated in these specific polymers, they feel the sting more acutely than a more diversified peer like Dow or BASF. This is where the tension between expectation and reality hits hardest. The expectation was a soft landing for chemicals in late 2025, but the reality is a prolonged cyclical downturn that has tested the patience of even the most seasoned dividend growth investors. Comment below how many shares of LyondellBasell you currently hold, or if you're waiting for it to hit that $36 target before buying in. Let's take a step back and look at what this company actually does and why it got here. LyondellBasell is one of the world's largest producers of versatile plastic resins, such as polyethylene and polypropylene. If you look at your kitchen, the food packaging, the medical supplies, the lightweight parts in your car, there is a very high chance LYB produced the raw materials for them. They also have a world-class technology segment that licenses manufacturing processes to other companies, which is a high-margin, asset-light part of the business that usually offsets some of the commodity volatility. For years, the company's business model included a massive refinery in Houston. However, in a major strategic move, they decided to exit refining entirely, with operations ceasing in early 2025. This was a move intended to reduce carbon exposure and focus on more sustainable, circular products. We're talking about a segment that used to contribute over 20% of their total sales. Removing it is like performing surgery on a major organ. The patient will be healthier eventually, but the recovery period is messy and expensive. The financial health of the company is currently the subject of intense debate on platforms like Reddit or within Fidelity Wealth Management discussions. As of September 2025, the company had about $13.2 billion in total debt against roughly $1.8 billion in cash. While their current ratio of 1.57 is healthy, their net margin has dipped into negative territory due to those massive write-downs. This is why the credit agencies are watching like hawks. S&P Global Ratings recently revised their outlook to negative. If LyondellBasell loses its investment-grade rating, the cost of servicing that debt goes up, which would almost certainly force a dividend cut. This is the sword of Damocles hanging over the stock. If you're a self-investing individual, you have to ask yourself if you trust CEO Peter Vanaker's cash improvement plan. He's aiming for $600 million in incremental cash flow by the end of 2025 and $1.1 billion by late 2026. If they hit those targets, the dividend is safe. If they miss, the 12.5% yield is a trap. Now, looking toward the future, the catalysts for a rebound are clear but require patience. The first is the ramp-up of their new world-scale PO/TBA complex on the U.S. Gulf Coast, which adds significant capacity for high-demand intermediates used in polyurethanes. The second is their MoreTech technology. LyondellBasell is building its first commercial-scale advanced recycling plant in Cologne, Germany, expected to start up in 2026. This isn't just about being green, it's about staying relevant in a world where plastic regulations are becoming increasingly strict. They're aiming to produce 2 million metric tons of recycled polymers annually by 2030. If they can prove that circular plastics can be as profitable as virgin plastics, the stock will re-rate significantly. The market currently values LYB at a price-to-sales ratio of about 0.36, which is ridiculously low compared to the industry average of 1.07. This suggests that the market isn't just pricing in a downturn, it's pricing in an existential crisis. As we move into 2026, the potential scenarios for LYB are binary. In the bullish scenario, the global manufacturing index starts to tick up, lowering interest rates spur construction and automotive demand, and LYB's feedstock advantage in the U.S. using cheap natural gas versus expensive oil-based naphtha in Europe and Asia allows them to dominate export markets. If that happens, the stock could easily snap back toward the $60 or $70 range as the dividend yield normalizes to a more reasonable 6 or 7%. In the bearish scenario, the overcapacity in China continues to flood the global market with cheap plastics, keeping margins razor thin, and LYB is forced to cut its dividend to protect its balance sheet. If that happens, we could see the stock test the mid-30s as income-seeking funds dump the position. When you're looking at your Robinhood app or checking your SoFi active investing account, it's easy to get discouraged by a sea of red. But professional investors often look for this exact type of maximum pessimism. The divergence between the company's intrinsic value, which some models place as high as $113 based on long-term free cash flow, and the current $43 market price is one of the widest in the S&P 500 right now. This is a classic example of the market punishing a company for the sins of the entire sector.